All right, my friends, so my last video I showed you by having John having about $200,000 or so in the Wellesley Income Fund wouldn't generate enough income in which he'd have to pay taxes on. All right, he still has some qualified dividend income. He still has some long-term capital gains. Even with taxable income, it wasn't enough to go above his standard deduction. It just was not. So in this case, he has $13,300 of standard deduction. The Wellesley was plus his money market account was only going to give him about $8,500 of total income to which he has to declare as part of his AGI. So you have an AGI of $8,500, standard deduction of $13,300. You have no taxable income whatsoever. All right. So the logical question, if we have any logic left in this country, and I'm not really sure we do, it's nuts. Anyway, the logical question is, well, should he start doing some Roth conversions, given he has no taxable income? And the answer is yeah, probably, but it's not that big of a deal. So let me give you the issue. John is 60 years old. All right, he's got about 1.2 million total liquid net worth, all right, of which 800,000 is in 401k, 400,000 is taxable money. He's going to quit working at the end of 31 December. He'll stop. He has no income, all right, so he's going to pull income from his taxable accounts, his bank accounts, and then going into Wellesley Income Fund. So he's got no taxable income, inherently no taxes. So the question would come to mind, though, what if we started using some of our zero tax bracket and started doing some Roth conversions? So I ran the numbers on Right Capital Software. I pointed down there like you can see that. That's my laptop there. And I'm just going to put you here on this whiteboard. All right, so basically I ran 4 different scenarios. I'm only going to show you 3 because the 4th scenario didn't make sense. All right, so the question is, should he just keep doing what he's doing? Should he go into a 10% tax bracket? Should he go to the 12% tax bracket? I did even go into the 22% tax bracket. It doesn't, and there's no benefit at all to do that. So the question is, do Roth conversions work if he goes to 12% tax bracket, 10% tax bracket, and just keeps doing what he's doing? It's not as and this is probably going to kill my own business because a lot of people hire me because they like my take on Roth conversions. So when I show you that's, in this case, it's not a huge benefit for him doing it. People say, I'm not going to hire that Josh. He's just going to tell me it doesn't make sense. And it might be true there. But, I'll tell you the truth regardless. Anyway. So John, what if you did no Roth conversions, just kept money out, just, take money out when RMDs come? We have John live until he's 90, by the way. And just, you're 60 years old now. You're just living off your assets. You'll take Social Security at 70. You got no Roth conversions. What happens? In this case, John, he'll end up paying $280,000 of total taxes, all right? His first 10 years, he'll only pay $51K in total taxes because years 1 through 6, basically first 6 years, he doesn't pay any taxes. And then he'll start progressively paying more and more and more taxes as the years go on. And then he will be hit with a tax torpedo a little bit when it comes to Social Security. The tax torpedo just means basically 85% of your Social Security is subject to income tax. That doesn't mean you have to pay tax on 85%, it just means it's subject to income tax. And again, you got to go to AGI, standard deduction, and then you got to look at your taxable income. But that does happen. Once you start having RMDs, required minimum distributions, at 72, and you're on Social Security, your Social Security most likely will be fully taxable. Again, 85% of your Social Security will probably be fully taxable. All right. So in this case, he's going to pay more taxes in the long run, but the first 10 years he pays $51,000. Divide by 10, that's $5,000 a year. All right. His success rate is 89%, means basically 89 times out of 100 he does not run out of any liquid assets, not run out of money because he will always have Social Security, but he's not run out of money. That's all there is to it. And this assumes that his spending is increasing each and every year with inflation. I think we had him spending about I think it was $7,000 a month discretionary. No, it's about $7,000 a month all included, I think is what it was, to include his mortgage and all that. So everything's the same. So it doesn't really matter exactly what the amounts were. It just matters he has a 89% success rate. His liquid net worth at death at 90 is $903,000. All right. So then we go, what happens if we just went up to the 10% tax bracket? He'll pay $60,000 in taxes the first 10 years, so $9,000 more. But he'll pay $207,000 in taxes over the course of his life. So significantly less. So it's $73,000 less than he would if he didn't do any Roth conversions. Now, the first few years, he's going to pay a few $1,000 in taxes because he's going to the 10% tax bracket. Not much. Essentially what that is, he's basically converting $22,000 a year, if that makes sense. So $22,000 a year to put him up at the maximum of the 10% tax bracket. He's essentially paying $1,000 to $2,000 a year in the first 6 years, where he wasn't paying anything before that, and then he'll pay a little bit more when he starts having to live off his IRA 401k. Either way, you can see significantly less in taxes, $73,000 less in taxes. He does pay more in the first 10, which shows you, though, in the latter part of his life, he's going to pay a whole lot more taxes here than he did here. That's just a fact, and that because as you get older, your required distributions become larger, your accounts grow more. There it is. Again, an 89% probability of success, so he's not run out of money, and he leaves $942,000 of liquid assets to his heirs. He doesn't have any kids. He's single, so that would be to the church, charity, his brothers and sisters, whatever. All right. Now, in this case, he does a 12% conversions up to the 12% tax bracket, and Right Capital allows you to do this pretty easy. It's pretty cool, actually. I don't think I've ever done a video solely showing this. Maybe I will. I need to because it's fantastic. $225,000 is his total taxes, so it's, again, significantly less than the 0%, but more than the 10%. The first 10 years, he almost doubles the taxes that he does if he doesn't do anything. So, the first 10 years is when you're partying like it's 1999, man. So the last thing we want you to do is have a big tax hit in the first 10 years. 89% probability of success here as well. If we did the 22% tax bracket, by the way, there's only 87% probability of success. So the 22% tax bracket, even though you pay no taxes from basically 75 and on, I think it was 73 and on, you pay so much on the front end that money did not recuperate in order to grow. So you only had an 87% probability of success, and you left a whole lot less to your heirs. So even though it looks good not paying any taxes in the long run, but you pay so much on the front end that money's gone. The opportunity cost, that money could not continue to grow for you. 89%, and then he only leaves $830 to his heirs. So basically, this is a no-brainer not to do that, in my opinion. We want to scratch that out, and if I can take my trusty pen here, we'd say, nah, don't do that. I don't see any benefit at all doing that. Now, again, there's so many. This assumes that the Trump tax bill goes away. What else? He's, again, single. He's got a 5.1% rate of return is what I'm projecting, with a standard deviation of like 11% or something like that. So yeah, a lot of assumptions to make. But then the question comes to mind is, look, man, he's going to leave more money here, even though he does pay more taxes, but he pays a lot less taxes in the first 10. And you don't want to spend that money on the first 10, because what if we're wrong? You're not going to recoup that $50,000 of taxes that you already paid. So don't do that. So the question would come, should he do a Roth conversions up to 10% tax bracket? Yeah, I mean, $22,000 a year makes sense. Is that going to make that big of a deal? No, I mean, it's not. He's going to pay more tax on the first 10. He'll pay less in the latter part of it. I get that, and he'll leave more potentially. But it's not a panacea. It's probably worth doing, and I'm going to email him because this is a client of mine and say, hey, man, you should do this. $22,000 a year for the first, basically first 5, 6, 7 years or something like that. And then stop. And then I think it was the first 6 years. So he'll convert 22 times 6, whatever that is, 150,000 or so. Yeah, around 150,000. It's not going to make it or break it that big of a deal. But it won't stress the portfolio on the front end by paying $98,000. He won't recuperate. Now, again, he's single. I want to stress this. If you're married, all bets are off because of what you're going to leave to your heirs. If you're leaving money to kids, this is different too, because there are other things that go in here. But a single guy without kids, it's just one of those things. Is it going to make or break him? It won't. But it makes sense to think about doing Roth conversions, at least up to the 10% tax bracket. Hope this makes sense. We'd love to hear your comments. Thanks now.